Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now.
It may not seem like it, but parts of the stock market are recovering extremely quickly, and there are a bunch of stocks now that have doubled from their 52-week lows. Joining me to talk about this is Jon Quast, who highlighted a bunch of these. Jon, you've got a couple ideas. What is the stock that you like that has doubled off its low that you still like from here?
So, Travis, the first stock that I like that has doubled off of its low is Crocs, symbol CROX. This is the shoe company, as you are probably well aware. I believe it touched down at a 52-week low of around $47 per share. I believe it was back in May. Currently trading at almost $100 per share. But here's the thing. This company is still trading at a very low valuation. And as you look at the trends moving forward, the Crocs brand is becoming more and more popular among the teens, among Gen Zers. They are very popular with the younger demographic, as well as their recent acquisition, Hey Dude. So Hey Dude is a shoe that is rising in popularity. Their sales are up astronomically during 2022. Some quarters even up as high as almost 90% year over year. Fast growing, and this company combined for the Crocs brand, Hey Dude brand, targeting $6 billion in revenue in 2026. So just a couple years from now, they're definitely on that pace. They're also targeting a 26% operating margin, which is the operating margin that they have now. So that seems very realistic to me, especially considering that there's room to grow the margin profile of the Hey Dude brand now that it's under Crocs' management. And so you do the math there, and that takes them out to about $1.25 billion in 2026 profits. If they're trading at just 10 times their profit in 2026, that's a double from here. So Crocs is one that I like.
It's funny. That's a company that I just simply have not understood because I don't appreciate Crocs, but I seem to be the only one at this point. And yeah, the kids are wearing them, so that's probably the place to be. The first stock I wanted to talk about is First Solar. So this is one that actually, I'm looking at the chart now, hit its lows in June 2022. Kind of interesting because it fell with the rest of the market, but then investors seem to realize, oh, wait, why are we selling off solar energy stocks when oil and natural gas are growing like crazy? Like, shouldn't solar have some benefits behind it as well? Then you tack on the Inflation Reduction Act, which was really more of a, how do we get more money into renewable energy act? And First Solar has done really well since then. The company is going to double their production over the next 2.5 to 3 years. A lot of that coming in the U.S. They also just announced a $1.1 billion plant in Alabama, of all places. I think it's really interesting that a lot of these companies are building in the South. Not only is it a lower cost place to build than a lot of these companies were building in California for some reason, but it's a political move too. I mean, this is the one area of the country that was kind of resistant to renewable energy. Well, now all of a sudden you're building electric vehicles, you're building solar plants. There's a growing number of solar energy farms actually producing energy going in down there. So it just expands the market for a company like First Solar. This is going to be, from a solar panel manufacturing standpoint, this is basically the one play in the U.S. because all of the other companies have been basically commoditized out as China and surrounding countries in Asia grew their silicon manufacturing. It killed most of the companies in the U.S. First Solar is the one that's left. It's going to see the tailwinds, not only from a demand perspective, but also their costs should be pretty good for these plants that are getting subsidies from the government. So, they're continuing to grow. I think demand for solar panels is going to continue to grow. They're potentially moving into residential solar panels, which would be just crazy for them because they've never had any foothold in that market. So I think there's a lot of tailwinds. I have kind of forgotten that I own this stock because I've just held it for so long. And so I just ride the waves. We're on a wave up right now, but I think over the next 5 to 10 years, this is going to still be a great place to be in the solar industry.
Guys,
Jon,
Travis
anything you want
has
to add
followed
there before we go into your second stock?
Well, yeah, I want to add that you have followed the solar space for over a decade. So, guys, Travis, when he says that this is a still good stock to follow in the solar space, it bears listening to. He has followed this space very closely for a long time.
Through a lot of ups and downs. So
Exactly.
take that with all the caveats that need to be said there.
Okay, for the third stock here in our list, I wanted to talk about Celsius Holdings, symbol CELH. This is the energy drink company, has been around for almost 20 years, a very long time. But in more recent years, they've started to gain that brand recognition that has really propelled the brand as they've increased distribution as well. But what is interesting is this isn't just an increased distribution play. A lot of customers go to Celsius. Amazon.com is one of their biggest sources of revenue. So people are going there, searching them out. Also, direct to consumer, they do some sales. So very, very popular brand among their customers. It has gained that brand recognition. And as they've gained that brand recognition, they've increased the distribution. And astronomically so. Distribution has more than doubled over the last couple of years. Now, here's where this thing gets really interesting. They just signed an agreement with Pepsi to take Pepsi is now the distribution preferred partner for the entire world for this brand. And so Pepsi even taking an equity stake in Celsius. I believe that if Celsius was able to grow on its own all this time and finally gain this critical scale so that people actually recognize the brand, have heard of the brand, Pepsi can really just take this to a whole nother stratosphere in the coming years. Now, one caveat with Celsius is they do trade at a premium valuation, around 15 times sales. Now, do keep in mind that a similar company, Monster Beverage, much more mature in its business life cycle, it's typically traded between 8 and 10 times sales over the past decade. So I think that's kind of your baseline valuation perhaps for a company like Celsius. I think that it's not unrealistic to think that they could triple or quadruple their sales again thanks to the Celsius or the Pepsi partnership, helping them gain international distribution. I don't think quadrupling their sales over the next decade is out of the question. So I think that this is still a company with a lot of upside here.
Yeah, that's one that I feel like maybe their regional reach is not quite. I'm looking at their site right now, and a lot of beach shots. That's closer to where you live in the country. I'm up here in the north, and Celsius isn't maybe quite as prolific up here, but maybe that's part of the opportunity is expanding that distribution to other parts of the country.
To your point, they did start in Florida, and a very big grocery market chain here in Florida is Publix. And Publix at times has accounted for more than 10% of Celsius's sales. So I think that does really show that, yeah, it's a big brand here in Florida perhaps, but that is the opportunity, especially as they partner with Pepsi to broaden that distribution even further.
I like that one. The final stock that we're going to talk about today is Axon. So this is a company that started as Taser International, makes tasers, then moved into body cameras, and then added a whole bunch of services on top of that, particularly software services. So cloud services for videos, but then analyzing those videos, sharing them between law enforcement and prosecutors. We now have a citizen product. This is the kind of business that has a great moat. And I think the thing that I'm appreciating more and more is that they have a lot of visibility into their future. Their contracts are now extending to 10 years in some cases with the government agencies, the law enforcement agencies that they're working with. And this is a very, very sticky business. So if you think about the way that they sell their products is they'll say, okay, law enforcement agency X, why don't you sign a 10-year contract with us? It will be X number of dollars per month. We will give you a new camera every 2 or 3 years. And then we will include all these software services with it. The camera itself is profitable. It's not extremely high profit, but the software services, the cloud services that Axon is selling is in the 70% gross margin range that you would expect for a SaaS business. Now, the challenge for them is if you look at their stock chart, they're not a particularly profitable company because they're spending money expanding the business, but they have shown that they can grow revenue 20 to 30% per year, just like clockwork. And I think that's what's really impressive is this is the kind of company that continues to churn out 30% growth just like it's nothing, while a lot of other companies are struggling to do that while burning cash. So if they want to turn on the cash machine, they just need to cut back on some of the sales and marketing spending, and generate the profits that they can from their high gross margin businesses. By the way, Tasers is an extremely high gross margin business, which I think isn't real appreciated either. So this is one where it's come off of its lows, up over 100% off of its lows, but I'm still just holding on. This is I don't see anybody coming to disrupt Axon's business. It's kind of like this niche that's big enough to be a great business, but small enough to not attract the attention of kind of big competitors that may want to swoop in and grab it from them. And the potential upside is moving into the consumer market. If you go back to the history of Axon, it was created because the founder's friend, I think it was, lost his life to a gun incident, and the mission of the company is to eliminate the bullet. And so if you are somebody who's interested in having a self-defense device, but you don't want a gun, well, maybe a taser is a really good option. So they're moving into those kind of products. Very, very, very small business for them today, but that's the kind of thing that really interests me a lot more than owning a gun manufacturer. And then I think there's potentially optionality in moving into security as well. I mean, they have the infrastructure and the products to make body cameras, well, and they tie into law enforcement. Well, why not make a competitor to a Simply Safe kind of a thing with your cameras on the outside of your home? If something happens, you could just hit a button and live stream to law enforcement and say, hey, here's exactly what's going on. Maybe that's 5 or 10 years down the road, but I think there's a lot of optionality for growth. So love the core, love the optionality for growth over the next decade or so. So that's why this is one up off of its lows, but I'm still holding on to this and think this has a really bright future. All right, what was our 4 stocks here? I had First Solar and Axon. John, which ones did you have?
Crocs and Celsius.
Fashion, advice, and fancy drinks from John is the theme here. Thank you, everybody, for joining us. Please give this video a like, leave any comments that you have in the comment section below, and subscribe to Rive Investing. I really appreciate it, and we'll give you all of our coverage from the market in the future. I will see you here next time.